Good evening. I am Sabrina Clark. As the president of the Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated, and on behalf of our members, I would like to welcome you to the Stocks and Bonds 101 webinar as part of our Smart Money Moves series. The Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated, affectionately known as ASAC, is dedicated to providing quality programs and leading the way in social action within our community. Whether you are a novice in investing or looking to expand your existing portfolio, we hope there will be information shared tonight that will aid you in increasing your financial wealth. I would like to extend a special thank you to our presenter, Deirdre Willis, and thank you all for joining us. Please enjoy the webinar.
Thank you, President Clark. We are excited that you all have joined us, and we know this will be an informative and pretty interactive webinar tonight. Before we begin, we have a few important points to share. First, our media disclaimer. You have entered an area where photography, audio, and video recording may occur. By entering the event premises, you consent to such recording, media, and its release, publication, exhibition, or reproduction. Second, your mic is muted. Attendee microphones are muted to eliminate background noise for others. And thirdly, we welcome your questions. Please post your questions using the Q&A icon. We look forward to your questions and we'll answer them during our allotted time for Q&A. At this time, we would like to have an Economic Justice Matters moment with Sharice Reyes.
Good evening. Thank you so much, Sora Hutchins. My name is Sharice Reyes, and I chair the Social Action Committee for the Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated. And social action is at the forefront of all that we do. So I'm happy to share some information with you tonight. First, if you haven't already, make sure you are registered to vote. The deadline to vote in the general election, meaning the gubernatorial election this year, is October 11th. If you've recently moved, please do update your address and make sure that you have a plan to vote. Know where you're going to vote, know when you're going to vote, but also talk to your friends and family and make sure that they also have a plan to vote and that they are registered by October 11th. In addition, because we're talking about smart money moves tonight, we want to give you some information about student debt relief. As you know, this current administration, the Biden-Harris administration, recently passed monumental legislation that will allow for certain borrowers to receive forgiveness of $10,000 or $20,000 on their student loans. Information about that program will be coming out shortly, and we will be here, the Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated, to give you that information to make sure that you're in the know. But did you know that there's already a program, the Public Service Loan Forgiveness Program, that has been in place for some time? Well, the administration allowed for a waiver that is in place up until the end of October that allows previous loans and previous payments to count towards loan forgiveness. So if you work for a qualified employer, such as the federal government or many state government or schools, so for our teachers, listen up. If you've made over 120 qualifying payments on your student loans, you may be eligible for forgiveness of the entire loan amount. Yes, not 10 or up to 20,000, but the entire loan amount. However, the information about this program has been slowly being distributed to the individuals who may be qualified. Therefore, that means if you have not applied for consolidation of your loan if necessary, or the loan forgiveness by October 31st, you may miss out on this important program. So you're probably thinking, but Sharice, it's already the end of September. Yes, and that is exactly why the Economic Development Committee and the Social Action Committee has a petition right now, change.org. Check the link in our chat. We want you to sign this petition. We are asking the administration, we are asking Congress to extend that October deadline to July when the actual regulations will become available. available so that all qualified borrowers have an opportunity to take advantage of this program. If you've engaged in public service and you've given back to the public, then you deserve an opportunity to seek eligibility in this program. For more information, click on the links below, sign our petition, share our petition, partner with us so that we can make sure that you, as a public servant, can make your smart money moves. Thank you, sorors.
Thank you so much, Sora Reyes. Please, please sign the petition. We will make sure we have that QR code available again at the end of the presentation. But by all means, we want to make sure that we not only get out the vote, but we also do what we need to do to get our student loans waived. All right, at this time, we will have our speaker introduction by Ms. Sora Terry Crook.
Thank you, Sora. I am indeed excited to bring to you Ms. Deetra Willis, CFP, Certified Financial Planner, CLU, Chartered Life Underwriter, and as a Certified Financial Planner Practitioner and Financial Advisor, she is affiliated with the Northwestern Mutual. Deetra started her financial services practice in 2012. Prior to Northwestern Mutual, Deetra began a professional career with International Paper and achieved success in her roles as financial analyst, internal auditor, and business development manager. With her true passion, financial literacy, and appetite to equip others in building wealth, never escaping, Deetra decided to return to her finance roots and hear me out, exit corporate America in 2012. Today, her practice, you heard me right, her practice is in constant growth mode and values working with professionals on the move, business owners, executives, and physicians who find value in the strategic, comprehensive planning she provides. Deetra's vision is to empower each individual she has the opportunity to meet through financial knowledge, education, and know-how. Implementation follows knowledge. And here's her quote: "The goal is to ensure you are better equipped to create wealth, sustain it, and preserve it for the next generation. Knowledge makes the key difference as it relates to money. It is truly by design to have the opportunity to serve others and impact future and present generations." Deetra is a Mississippi native. She is a Madam Cum Laude graduate of Mississippi State University with a BA in banking and finance. She was initiated into the Nu Beta chapter of Delta Sigma Theta Sorority Incorporated in spring of 2003. Deetra is heavily involved in the community and serves on various community service organizations in the local Charlotte community, including her church, her sorority, and serves on the board of Career Master Magazine Executive Advisory Board, Northwestern's Mutual's Women's Skill Association as board member, and co-chair of All Women Advisors and Northwestern's Mutual's African American Advisory Council. She was awarded with the 2021 Charlotte Business Journal Women in Business Award. She enjoys bringing out the best in others, a great workout challenge, and redeeming time with dear family and friends. Ladies, I am just thrilled to bring to you Ms. Deetra Willis.
Good evening, everyone. I am delighted to join all of you on this evening. I hope you can certainly see my screen that I am sharing. Let me pause and make sure that you can indeed see my share. All right, we're back up and running. First and foremost, thank you, Sora Crook, for that phenomenal introduction. I think I had chill bumps just listening to you make that introduction. It is more than a delight to be here this evening. My hope is that you will gain the knowledge to truly get the smarts to make smart money moves. I am more than honored to partner with ASAC, as is affectionately called, and I'm more than honored to have the introduction by my dear line sister, Akila Minor. So on this evening, we're going to speak to stocks and bonds 100%. However, we will speak very much so high level to investing as a whole. I want you to certainly take notes. This is going to be an interactive forum. You have the ability to drop your questions in the Q&A, and we're going to get started. So again, I am Deidre Willis, certified financial planner, practice owner, starter life underwriter, and more than anything, I'm a person who is committed to the success of others through clarity, knowledge, and implementation. So let's get going. All right, investing. The important part about investing is learning to invest your way, right? One of the things about money has a little to do with money. Everything about the market, there's going to be movement, there's going to be volatility. But what you want to first open your mindset to is, what is my investing personality? And that's something that you have to create, right? We all know that there are so many different ways we can invest. We have this thing called a device today that we can invest that way. We still have the capacity to invest using others. But how do we hit the bullseye, right? The goal that we're really seeking to accomplish is figuring out the best way to invest my way. So we have to determine what is our personality, how do we invest, is there a brand that we're looking to invest in? We know we can invest when it comes to cash. We can do some things digitally speaking. The hope is that you would uncover who you are in the world of finances, in the world of building wealth, and more importantly, know yourself so that you can determine the best approach to investing. So to get going, and to start with Stocks and Bonds 101, we're going to begin with the 101. And the 101 really starts with what is investing. There could be a lot of misleading terminology, a lot of different ways that we need to invest. And how do you invest? So first and foremost, investing is taking a resource. In this particular case, it's money with an expectation of achieving a profit, wealth, or an opportunity. So when you're thinking about investing, the key that stands out here is that you have an expectation with these particular funds that you're choosing to invest. And that expectation is yielding some type of growth. Obviously, we got to have the resources, not necessarily our money, it could be someone else's. But to invest is certainly having a resource, expectation, and ultimately that end result. So what do you need to invest? We need capacity. Capacity comes in time, it comes in mental capacity, knowledge, and it also comes in finance. So when you think about time, one of the things that's important is, do I have the time to invest? Or do I want to bring on someone on my team, such as myself, who can give me my time back? What about capacity when it comes to knowledge? Or even the mental ability to say, I'm ready to invest. And then obviously, we got to have the resources, as I just mentioned, from a money perspective. Lastly, how do you? If you don't take away anything else this evening, we're going to really talk about you a lot tonight. You have to define your goal. Investing is, what is the purpose of this money? When do I have a need for these funds? What do I want this money to do? If you can identify what's important to you, the purpose of this money, you've already created this smart money move because you're telling your money how you want it to go and prosper for you. So to begin with investing, we have to ensure that we have the resources to invest. We have an expectation for a profitable return when we invest. We have the capacity, or we can collaborate with someone on the resource, time, money, knowledge, and we must have a goal in mind. This is the first start to creating success when it comes to investing. All right. So we're beginning with the 101. I'm going to shift. I'm going to go into discovering the 101 because this is where we start to have some dialogue. We really start to hear what's on the hearts and minds of each of you this evening. So here's why I want to begin with a poll. And I want us to go ahead and launch poll question number 1. This particular question is engaging on, are you currently investing? If you will, take a moment to respond to this question for us. We'll give it about 5 more seconds. All right, results are in. Here what we have 74% are investing. That is phenomenal. We have 26% that is not investing. For the ones who are investing, if you would drop in the chat, what are you currently investing in? Are you investing in yourself? Are you investing in the market? Are you investing in people? Are you investing in other assets? I'm curious to know what you're currently invested in, and even ensure you drop in what you want to be investing in. Now, I want to also talk about the 26%, because the 26% is just as important as the 74%. And so with the 26%, let's go ahead and figure out why not, right? What are the reasons that have kept you from investing? Let's launch poll question number 2. And while you're completing that, the 24% or 26% that has not invested, what I'm hearing is that most of you who are investing in real estate, you're investing in the market, you're investing in people. This is wonderful. You are currently investing in real estate, stocks, crypto, estate, phenomenal. So we have a variety, and this is going to be very instrumental conversation around what you're currently doing. All right, so we're going to close out the poll here as it relates to the ones who are currently not investing. And this is what we have discovered. 53% is not exactly sure how to get started. We're going to answer a lot of that on this. We're going to make sure that the barrier of entry is not going to be the reason why we don't have the opportunity to take advantage of investing. Then we have 45%. I'm not quite there yet, financially speaking. One of the things that we're going to speak to is how we lay that foundation first. This is critical. We have to make sure the money we choose to invest is truly available for us. It is not compromised for a need, if you will. And then there is a fear. We understand that it's certainly a fear when you think about investing. So as it is, one of the things that we know when it comes to the stock market, it is truly 100% uncertain. And when it comes to that, we have to continuously eliminate the uncertainty by gaining the knowledge, because we know that there is a fear of intimidation. So I'm hoping this is framing the mindsets of what you're currently doing, and those who want to invest, how are you going to be able to join in on this train ride? All right, so let's begin with a really quick knowledge 101. The reason why I want to do this in this particular order, because oftentimes we just talked about 45% is the fear of investing. Some of that fear is because we don't understand terminology. We're going to take that off the table this evening. Now, we have 22 terms. There are several that's out there. These are some that stands out, and it also honors our 22 founders. Now, one of the things that we're going to do here, I'm going to blitz through this. Don't have the time to expound as much as I would like, but certainly you will walk away with a high-level definition. Take notes. There may be a quiz, but there will certainly be a higher level of I'm ready and confident to invest. So money smarts around knowledge. Asset allocation. Asset allocation is a fancy way of stating this is how I'm choosing to invest my money in a particular portfolio. In other words, think about the mix of your investment. How much do I have in cash? How much do I have in bonds? How much do I have in... That's how you allocate your assets. Reserves is essentially funds that we have taken off the table. It is completely unavailable for the purposes of investing. I have this money reserved, restricted, earmarked for a particular purpose. Liquidity. Think about the availability of money. Essentially, I have the ability to get my hands on these funds relatively quickly. That is what the terminology liquidity means. Principal. This is my initial investment. I'm starting an investment with $50,000. That is my principal. Basis. Basis is also part of my principal. It's what I have invested in my money, perhaps even some added costs or dividends over the time I paid already taxes on. So basis is important because when you go to start distributing your assets, that basis that's part of your funds have already been taxed. So it's not taxable to you. Time horizon. Time horizon is essentially the time I intend to invest my funds. Stock market, pretty sure we are all quite familiar with the stock market. However, I would never assume it is an exchange. Essentially, a stock market is a transaction of buying. Thus, you have buyers and sellers. First thing to note, in the stock market, regardless what the stock market is doing, there are always winners, there's always losers. So just be mindful of that. Nasdaq. Nasdaq is a stock market, is an American stock market exchange. Traded in, is located in New York. It is the second largest stock exchange next to the New York Stock Exchange. When you hear Nasdaq, or when you think about Nasdaq, or even when you hear in the headlines, oh, the Nasdaq is down, etc., consider the fact that the attraction is primarily tech companies. So oftentimes when you're hearing of volatility, fluctuations, it's because something innovative is happening, something's happening or the tech stocks, right? Then we have the S&P. The S&P is a stock market index. It is tracking 500 large companies, hence the S&P 500. Stocks, bonds, real quickly, stocks means ownership. So anytime I invest in something, I'm taking ownership in that. Bonds means debts, or essentially debt equities. So I'm giving a loan, either to a company or to an institution. That's the main difference. So we're going to expound upon that a little bit more. Mutual funds, index funds, ETFs are very similar. So all of these are a conglomerate of either individual stocks, individual bonds, or a combination. The main difference between these three is how they are managed. When you have a mutual fund, it is actively managed. You have a fund manager. We have the index fund. It is passive. It may be very similar to having the S&P 500. I'm just going to follow an index, if you will. If you have an ETF, exchange traded fund, it could be either a mutual fund or an index fund in terms of active or passive. Another key difference that I want to highlight between these three, mutual funds and index funds, they trade at the end of the day only once. Whereas an ETF is truly a mutual fund, but it trades like a stock. So you'll see fluctuation in price. You can trade it throughout the day. So it's a little bit of information. Expense ratio, the fee for the actual funds that you are invested in, or this is another way to say it, this is what it takes to manage the fund, right? And depending on how you choose to invest, if you have more active management, you will have more of a fee. If you have less active management, you have less of a fee. Sell, buy. Straightforward, I know, but I know we've all heard the terminology. Buy low, sell high, right? Bull versus bear. So bear market, bull market. A bear market is essentially a circumstance in the market where we have sustained decline. Essentially, we're starting to get at 20% loss or greater from a market standpoint. That's what I mean by we're in bear territory. We're down and we've sustained at this level for some time. Bull market is the opposite. It's a prolonged series of appreciation and growth. So that's really the main difference. And then return. Obviously, it is the percentage based on our investment. So it's the movement, the growth, if you will. Here, what we do know is that when we have a better understanding of terminology, that means we have knowledge. Once we have that knowledge, we have information. No one can take that away from us. Applied knowledge is power. So don't just take this knowledge this evening. Apply this knowledge, and that's when you now know your power. All right, so we're still making smart money moves. I'm going to do a really quick check-in. This is not going to be a poll, but I want you to engage with me on the chat, right? And if you would, drop your understanding of these terminologies. If it's not all of them, maybe it's one of them, but what is asset allocation by definition? What is basis? What is bull versus bear? What is stocks? What are bonds? Please drop that in the chat and engage with us for a brief moment here. All right. Asset allocation. Davion, thanks for sharing, is how you diversify your assets into different buckets. Got it. Investing is taking a resource with an expectation of mastering wealth. I love that, Ashley. Genevieve, stocks is a tangible piece of a company. That's right. Very well explained. I love that definition. Who else want to share what you gathered from basis, bull versus bear, or even bonds? Basis is what I have invested, says Crystal. Thanks for that understanding. And we'll give it a couple more seconds and we will deviate on bull versus bear. Rita stated bull is up, bear is down over time. I love it. Here's the one thing I'm going to say, and thanks for sharing that, Rita. As much as you can keep investing simple, you will not have a headache. Here's another tip that I did not include. But the market is fickle because people are. And what I mean by that, there's a lot of emotions. If we can remove that, take that off the table, if we can go back to knowing who we are and what's important, we won't move because the market is moving. Stocks is what I own. Bond is a debt security. Excellent. Thank you all for sharing indeed. All right. And so I'm going to continue with a tip. The first tip that I want to develop for all of you going forward is to get that knowledge, to rid of the fear, to even expand and become more of a sophisticated investor. Establish a regular cadence to tune into a reliable source. This will help you to elevate your level of understanding. You can go to CNBC. Doesn't have to be on a daily basis. If you have 10 minutes at lunch to pop in, you'll start to hear what's happening in the economy, what's happening in the world, what's happening in this particular industry. All of those are factors to knowing why the market moves how it moves. So I don't necessarily have to respond unless my appetite for this has since changed. You can go to Barron's, Bloomberg's. We all have stock app on our phones. Market Watch, Wall Street Journals. These are just some that I have listed here. But the first tip is figure out where you're going to go, develop a regular cadence, weekly, daily, monthly, but stay in tune so you can start to build your level of knowledge as it relates to the market. So what we've done thus far is we've gotten some knowledge. We started to build the 101. We started to discover the 101. Now let's get to accomplishing the 101. So how do you invest? More importantly, going back to having an investment personality, how do you invest your way? Here are the 3 things that you must start to master. Knowing yourself, knowing your time horizon, and knowing your risk tolerance. How many times have I mentioned you have to know the stock market, you got to know what technical analysis is saying, you have to understand fundamental investing? I have not. All those things are very important. I haven't mentioned anything about the PE ratio, Sharpe ratio, any of that. Because the reason why I have not, everything starts and stops with you when it comes to investing. So first and foremost, know yourself. What are my goals, if we've already discussed? How long do I foresee investing these months? When do I have a need for this money? Are there any particular scenarios, circumstances? What can cause me to deviate from my investment plan that I should be considering so I can consider my time frame, right? And then from a risk tolerance standpoint, in other words, what is my appetite for risk? And here's the important notion. If you have a goal for investing that is probably short-term in nature compared to a goal that is long-term, you probably have 2 completely different risk tolerances. A risk tolerance questionnaire will assist you with that. We normally take about 10, 11 questions. We walk through various scenarios. It is essentially ensuring your behaviors are addressed from an investment standpoint. Your level of comfortability are addressed when it comes to investing. So once we can discover who we are, knowing how long we need these funds, and also understand our risks, then we are well on our way to accomplishing how to best invest. So let me go into some methods of which we can invest. I'm going to start with the traditional methods. We talked about stocks, we talked about bonds, we know exactly what they are. We know stocks means ownership in a particular company. So anytime I'm owning anything, I'm owning the profits, I'm owning the risk. The reason why you'll hear stocks and bonds mentioned together quite often, but they're completely different. Stocks, as we very well know, has appreciation. That is the goal, but there's also a potential for great loss, right? When it comes to bonds, and that's more of a debt, the reason why sometimes bonds appear to give us that fixed income or that safety, because when you make a loan to someone, there's a commitment, there's a promise, or there's to some degree a guarantee to repay. Not to say that bonds cannot be defaulted on, but that's the reason first and foremost why if I invest in stocks, I know I'm taking more risk. If I invest in bonds, I'm taking a little bit less risk because technically I have somewhat of a commitment when it comes to the bonds. So how do you start to select these? It goes back to your time horizon, right? If you are an aggressive investor, if you are a balanced investor, or even if you are conservative, there is a portfolio that we construct that pairs with that level of risk. Ideally speaking, when it comes to bonds, if I'm creating a portfolio and I'm aggressive, I'm probably going to have at least 80% exposed to the market, maybe 20% I'm going to take off the table and put it in a fixed scenario such as a bond. If I'm a little bit more conservative, it may be only 20% exposed to the market, or even 30% at max exposed to the market. So how do I select my bonds? First thing you want to do is figure out, are there any particular industries that I desire to invest? And if I do, you must have diversification. Diversification is key. In other words, if we are interested in technology, if we're interested in innovation, AI, et cetera, what's a really great offset to that? We want an industry that has a company inside of it that's doing well, that would not have any impact to what's happening in technology. So maybe if it's not tech healthcare, it could be healthcare. It could be consumer durables. It could be consumer staples. So you think about starting to blend more than anything high level. Now, granted, you have to pay attention to your interest in investing. Oftentimes you'll hear some say the best place to get started is with what you know. It is, but also tune into what are the outlooks in certain industries that are growing, what's happening, what's going on when it comes to 5G or AI, what's happening when it comes to travel and entertainment. So if you can start to think with the end in mind and with growth in mind, and you pair that with a little bit of research, this is how you start to select the best stocks. All right. So I'm going to continue. This is one piece that I wanted to include because oftentimes our view of investing is quite short-sighted. And a smart investor understands that certainly there is uncertainty. A smart investor understands that when it comes to investing, there's a level of risk. A smart investor understands that we have to diversify when we invest. A smart investor also understands that the market becomes, the declines are expected in the market. They are to be expected. So one of the things that I'm going to highlight here is how to think about investing. Do we all have our time horizon in mind? If you're thinking about investing or if you're currently investing, do you have your time horizon in mind? If you do, drop 1 in the chat. If you don't, drop a 2 in the chat. Because if we can start to see that we have our time horizon in mind, we already have an idea of our view and what we can anticipate from the market. I have someone who said, I'm not yet figuring out what my time horizon is in mind. We want to go back to thinking about the goal and when we have a need for these funds. If you do have a time horizon in mind, here's the thing to know. Let's look at history. While there is a risk for losing, and we are certainly experiencing that today, what's important to know is since the inception of the stock market, which was in 1926, the market has been positive 74% of the time. We've had 26 down years if we only consider a 1-year return. So in other words, the best way to think about that, if you only take a look at the market from January 1, 2022 to December 31st, 2022, we may feel as though we had a bad year. And that could be accurate information. But we have to start thinking larger and thinking in terms of how long am I investing? Because when you go and take a look at a comparison, and declines are expected, there is volatility when it comes to investing. Over a 5-year period, the market has been positive 87% of the time. So if you take a look and annualize is the terminology that we use over 5 years of history, you can see the market has been positive all but 13 years. If you look at a 15-year annualized return, the fact of the matter is that the market has always been positive over that 15-year period when it's annualized. What's the takeaway? The takeaway here, when you think about investing, I have to know my risk tolerance. Therefore, going back to, if I only have 5 years, I'm going to pay attention to my allocations, and I'm going to make sure that I'm constantly reviewing, making modifications as needed. However, if my time horizon is another 20 years and my appetite and my objective has not changed, I'm not changing because the market is changing. We have time on our side. You have the ability for the market to correct itself. So I want you to have that understanding that there's going to be movement. But what lens am I looking at, that time frame, to understand the impact of it? The one thing that we know that when we go to invest, it's never truly investing or the market is in. It's when we need our money. So the more important component is the sequence of returns. We're going to talk about how we can ensure that we just don't rely on one thing that's in the market, but we have a sequence of returns as well. So the second smart money move. Here's the key. When the market is doing this thing, or we feel a little bit uneasy, rebalance. We should be rebalancing on a consistent basis, and rebalancing just simply means if I start out and I'm a 50-50 investor, 50% stocks, 50% bonds, and the market is now, and I'm leaning towards more heavily, now have 60% in stocks and 40% in bonds, I just bring it back into balance. That is rebalancing. We do that when the market is crazy or we feel a little bit uneasy. However, we do not readjust based on emotions. Never move money, never completely respond because someone said, oh, the everything is coming to an end, right? We have to still stick to the discipline, right? A smart investor is a disciplined investor. We're not driven by emotions, but we know exactly what the end goal is. So if you would take away anything to apply towards your investment strategy, rebalance. Don't readjust based on emotions. All right. Let's talk about alternative investing. These are also some other ways of which you can invest. We had some in the chat who shared that they are investing in real estate, which we know it can be a really great way to invest. Sometimes we own properties, we sold properties, or we just kind of held on, and that's one of the great ways to get going. You can also pair with others. It's important to think about pooling your resources together, and you also have an option to do real estate investment trusts or REITs. They're essentially, think about the strip malls, think about, you see a Home Depot, you might see a few more stores. There's a capacity to invest that way. Private equity, venture capital. Main difference when you think about these two, when you see private equity, these are funds going into private companies. When you see venture capital, these are funds going into startups. So think about the name, it's going to really give you the indication of what it means. And if you have those opportunities, the best thing to do is do your research. Private equity is already established. So if this company has performed quite well, it just simply means it's not traded on the stock exchange, but it could have some really good history. Venture capital, really we're investing in companies with the probability for growth. We have has really great outlook. So that's another way to consider investing. Angel investing could technically, actually it is inside of private equity or even venture capital, but the difference is that to be an angel investor, you're a high net worth individual, carries a certain level of standard and requirement. So that could be an angel investor investing in private equity or even venture capital, but you don't have to be an angel investor to invest in those things. All right, Bitcoin, Nfts. I know that this has been a hot commodity and a hot subject matter. Here's the first thing I'm going to say. Well, let me first give the understanding. These are digital ways to invest. The more important piece is to understand the technology behind it. Understand where we're going from a market perspective. So Bitcoin is a type of cryptocurrency. Cryptocurrency is a digital way to invest, as we very well know. NFTs, non-fungible tokens. Think about collectibles. Think about one-of-a-kind type of items. You have things in art. You have things in music. You have jerseys. You have things that are one-of-a-kind that's of value, whether digitally speaking or physically speaking. People are investing in these things. Now, what we do know is that anything that's relatively new is going to always carry risk. So this involves doing research. And remember, all Alternative investing is for those who've established their baseline first. You've done some traditional investing, you're starting to master that, or you have your game plan in place. And more importantly, you have a plan, right? So before you make these smart money moves, ensure you understand them, ensure they pair with your appetite for risk, and know what are the risks and the possibility of getting to levels of investment. All right. So here's one thing that I'm going to say. It is no secret that no investment strategy can guarantee a profit or protect against loss. All investing carries some risk, including loss of principal investing. It's no secret. We know that when we invest, we take a risk. But how do you master the art and the science of investing risk, right? Because there's a way to master it. What you can do is diversify. You can also create a portfolio of options. The one thing that we want to create as we're thinking with the end in mind, we're thinking long-term, is we want choices. It really matters. And so I'm going to get into how we can start to master now the 101 of investing. So to gather a deeper understanding, I'm going to go a little bit deep here because more than anything, I want you to understand that there is a method to the madness of investing. First thing is you can see that there are various vehicles that we have here. And without getting too in depth, the main notion that we're creating are options. They all carry different tax treatments. There may be different times we want to have access to them. So when you think about investing, start to think about building some money that's in the market, some money that's not in the market from a cash perspective, and even some things that may carry a guarantee. So as we're thinking, and particularly we're going to speak to retirement because all of us are aiming to get to a point where we can call it quits or thoroughly enjoy our retirement. Annuities, understanding that. Why is that critical? This is important because to some degree, if we want to have a guarantee of knowing that we're going to have a stream of income when we retire, an annuity might be a very useful vehicle. It allows you to defer income, it allows it to grow, and at some point, what happens is that you can turn on the income stream. So if we don't have things such as the income annuity or Social Security that we're not relying heavily on, or even a pension, it is essentially creating your own guaranteed stream of income, right? We now have also retirement accounts. We have the 401k, traditional IRA. This allows us to invest, taking advantage on the front end. Upon distribution is when we actually pay taxes. Or we also have accounts such as a Roth, which is the opposite. I'm going to go ahead and pay taxes now because upon distribution of my principal, right, my basis that we spoke about, as well as my growth, my capital gains, it is all distributed tax-free. So creating this gives us options, but it also gives us the ability to choose which is the best scenario considering our taxable case. Right. Another thing that's important is leveraging insurance policies. Now, this is particularly investment grade, cash value life insurance. They give you the ability to have another tool that complements your investment because generally speaking, these policies are not in the market and they are highly leveraged for the purposes of having a safe dollar component. In other words, it is essentially having cash. So if the market is down, what we do know is going to the market while the market is down, we're taking a double hit. So if we're currently retired, we have a 401k or an IRA, but we don't want to, if our portfolio is currently down 20%, go to an alternative that's going to give you a cash alternative or even cash that you have on hand. It allows your market assets to recover. And then what we also know is that we can have businesses, and businesses are part of the investment too. In this particular bucket are very important pieces of business, because what we do know is if you sell, it's certainly going to yield profits and or a stream of income. We can also have real estate here. We can have things such as brokerage accounts, individual stocks and bonds, mutual funds, et cetera, that might be intended for the short term, but it will be a mid-term bucket as well as a long-term bucket. So more than anything, while we may be speaking to investing and getting our knowledge and starting to figure out what stocks or what companies are we interested in investing in, think about the plan. If you have an overall plan, you created an option. You created the best of all worlds where you get to choose. And what is the most powerful component is not only having one option when you have a need for something, but the ability to be strategic. All right, so mastering the 101 is not just what we've talked about, because before we get to that point, what we have to make sure that we do is protect our investments by building our money smarts against the unexpected. So there are emergencies that happen. Before we go and we invest, let's make sure we have built our proper household reserves. We talk about reserves as one of the terminology. This is money that is earmarked. It is set aside. It is not to be utilized. So we want to have that in place. The recommendation is 3 to 6 months. 3 months if there's dual income in the household and it's comparable. 6 months if there is a single source of income or if dual income is not. We also want to establish proper protection. What we do know is that we can work very hard to create. You just saw that we can have multiple streams of income as it relates to investments and assets. But if we haven't properly protected ourselves, what typically happens is that we go to those things that were intended for a completely different purpose. So ensure you properly protect yourself first. Anything can happen to our vehicle, our home. There could be a sickness, an injury. There could be a long-term care event. It could be, unfortunately, the inevitable. We have to ensure we lay the groundwork of managing risk. That is your foundation. Manage risk first, start to build on the wealth accumulation. If we don't do that, then what we work hard for, we will have to deplete. So that's protecting against the unexpected. Now, what about the expected? Because what we do know is when we're investing, there's inflation, there's taxation, there's a little bit of volatility. So to plan for inflation, smart investors are always thinking, I gotta have a portfolio that is going to either match or exceed inflation. Not only that, they're also thinking about cash on hand. Outside of what we need for the purposes of our 3 to 6 months, or if that's not comfortable, perhaps we want a little bit more. Above that level, we have to have those funds working. Because if we don't, what happens is that we're starting to lose purchasing power due to inflation. So as we're growing our money smarts, let's make sure that our portfolio is positioned to match or exceed inflation. Taxes. What's important here is, as we just discussed, let's be mindful of what vehicles are favorable from a tax perspective. Let me understand my tax scenario. Let me take time to think through, when I retire, am I expected to have a greater lifestyle than I currently have today? Or am I expecting to have a lesser lifestyle? Am I expecting to have a greater lifestyle? I may want to go ahead and pay taxes now because I don't want to pay taxes on a higher level of income. If I am anticipating having a lower lifestyle, I may be open to paying taxes later. So that is also critically important as we're thinking about which investment vehicles are taxable upon distribution and which are tax favorable upon distribution. Volatility. I want to speak to volatility because what we do know is if we can master more than anything the acceptance of volatility, as I mentioned before, smart investors understand that there's uncertainty. Investors understand that the market is going to move. If we diversify, if we have cash alternatives, and more importantly, if we know the goal that we have in mind, we can accept volatility and we can be prepared for the expected. So this is to couple with having a portfolio across various asset classes, diversification across various asset vehicles, and then also planning for the unexpected before we invest and plan for the expected while we are investing. So I want to leave you with this, and we're going to open it up to questions. So please drop your questions in the Q&A. We have some time to go through that. I'm more than happy to ensure you continue to develop in your knowledge base. Investing involves setting the expectation. We open the conversation with that. We know that investing is taking a resource, and in our particular case that we've been discussing is money, with the expectation of a profit, wealth, or an opportunity. So if you don't have an expectation when you invest, you may not get the results that you anticipated. So set your expectations. Another component is set your expectations with yourself. Am I truly ready to invest? Am I being realistic with the time frame that I'm giving myself to invest? Remember, if we're short-sighted and we've been investing for 3 months, we haven't gotten those results that we expected to see, don't pull out. We haven't given the market a full cycle. The market needs to cycle for 12 months before you can even see any activity. And if the market is in a down year, such as 2022, simply due to things that are unsystematic that we can't control, you need to give it a longer duration. So setting real expectations around that time frame is best before we even begin with investing. When is it a good time to invest? Not necessarily because the market is down. Is it a great time to take advantage of that? Absolutely. But when it's a good time to invest is when we've accomplished all the things that we just mentioned. Personally speaking, I have the capacity. I am not taking funds from my needs. I have displacement spending. I have an understanding of what's important to me. I know I have my protection components in place. That is a good time for you to invest. When it's not a good time, when we don't have those things established. So we have to make sure that we set ourselves up for success, because if we haven't done that, prematurely we can exit investing and now we have a bad experience. But if we give ourselves the ability to be successful in investing, you know it's a good time to invest. Now, if we're currently investing and we have more money to offload, and we have the time to take risks, there's not a major expense or anything forthcoming, it might be a great time to take advantage of the down market. Because here's the notion. When the market is down, remember, the stock market is an exchange of buying and selling, right? So when you hear that, okay, I should buy low, I should sell high, it just simply means that when things are down, we're getting at a discount. The market is going to automatically correct itself. So if we're there and we're positioned, be mindful of that could be potentially a good time to invest. Last but not least, you have to know your equation. You have to know your personality. What's so important to you is not going to be important to the next individual. So while there's a lot of group speak and a lot of masterminds, and even there could be investment clubs, or there could be someone that you go to, make sure you understand your particular scenario and not make it generalized. So knowing your equation goes back to knowing yourself, as we've discussed, knowing your time horizon, as we've also discussed, and knowing the goals that we have in mind, which means my risk that I'm willing to take. And once we have this mastered, you would indeed have the money smarts to make smart money moves. Thank you all for your time this evening.
Oh, thank you, Ms. Willis. You have given us a lot of food for thought, and we have quite a few questions. So I'm going to go ahead and ask the first question, and I do want to remind our attendees, please use the Q&A feature and not the chat. And if you are following along on Facebook Live, you can go ahead and put your question in the chat, and our tech team will make sure that we are able to ask that question. So our first question is, would you be able to give some insight on how to invest using bonus equity stock provided by an employer?
Excellent question. I would be happy to give some insights. So first thing is, when there's bonus equity question or stock that's provided, we have to know the type. There are various types. You can have restricted stock units, you can have incentive stock options, so RSUs, ISOs. Let's suppose that once we receive them and we've held them for a period of time, they've vested. You now have capacity, and those are typically restricted stock units. You now have the capacity to allow those stocks to remain where they are, or you can also sell. What typically makes the most sense, it depends on the company. And it also depends on what's happening in your world. And what I mean by that is, if it's a really strong company, you don't have a need for those funds right away, I would encourage you to consider allowing those funds to remain. So there's great and more appreciation. Or it could also be the reverse. If the market has been on a complete high, we have an opportunity to do something else, or we've been wanting to do a project. Because of that time of you having to pay taxes once they're vested, you can still take those funds out if needed. If the market is down, if there's not a need for the money, you certainly want to give it time to recover and rebound. It's only upon appreciation that it may make sense for you to leverage. So if you consider your scenario and determine what's the best solution for you, that would give you that opportunity. Now, you can still take those funds out if you want to diversify even greater, invest in something else. That's also a possibility. But make sure that it makes sense for you and it gives you that position for growth.
Thank you. Okay, our next question is, When making an investment, when do we know when to stay in or get out? We know you'll lose money, but you want to win in the end.
That is 100% correct. When making an investment, when do I know when to get in and when to get out?
When to stay in.
To stay in. Okay, so what I would tell you is this. Number one, go back to the goal that you have in mind. That's the first thing. So don't move unless you're still aligned with your goal. The second thing is, have I given this particular investment a few cycles? And have I been invested for a number of years, essentially is what that means. So you do want to analyze how you're currently invested. You do want to rebalance. And there are times where you have to pull out some of the losers, but we wouldn't do that just because it's short-lived or because the market is moving. So I think once you've had an opportunity to see that true performance, or you can determine that there is something that is specific to this company or the industry, you want to have broader diversification or offload, that is probably a time to consider it may be time for me to exit this particular security in my portfolio, right? Now, staying in oftentimes also makes sense based on how much we've lost. So I can't really give the perspective but without seeing like an entire portfolio, entire plan in the picture. But if we've been down for quite some time and the loss is great, or there's a taxable implication that could be great, sometimes there might be a reason to stay in, but we should still have a strategy that pairs with wins. Great question.
Thank you. Okay, next question. If your funds are in an IRA or 401k, how can you utilize these to improve growth since they include some stocks and bonds?
Great question. If it's inside of a 401k, the truth of the matter is that your 401k funds have already been vetted. So what you have available to you are going to be your options. The best way for you to be positioned for growth goes back to, am I properly allocated? So what you want to do there is take a look at your overall portfolio, do a really quick risk assessment, determine, am I allocated according to my risk tolerance? And possibly what could be happening is that I can take a little bit more risk. Have I deviated? I'm now more into cash. But make sure that you widen that view as it relates to investing so you can have a broader diversification component. I think that would be a really great way to do it. And again, because that's limited, there's not a lot there. So it's more diversification and being properly positioned. When it comes to an IRA, so with an IRA, you have access to thousands of options, right? That could be a matter of making sure that you're paired with the correct fund, or if you have individual securities, it's a matter of, are they pairing some tolerance? Because there's never a guarantee that, oh, if we choose to go with X company or this particular fund, that we're going to, get that return, but it should be paired with the amount of return we're willing to take. So that would be the scenario as it relates. In the 401k, ensure that you're properly allocated. In an IRA, open up the selection because you have so many options inside an IRA.
Okay, thank you.
Mm-hmm.
Next question. With the rise in cryptocurrency, how much of my portfolio should I invest in, if at all?
So ensure that you reach out to me directly. And the reason why I say that is because this question is it's almost impossible to answer without knowing what all you have invested. Here's what I would tell you is cryptocurrency is not for the faint at heart. If we think that we're uncomfortable with the stock market, it is certainly 100 times more volatile. So when it comes to that, again, that particular response would be a matter of how well have I already built out my portfolio? How well do I already have my other components in place that provides financial security and make sure that I'm on a path for success when it's time for me to have access to my money? If we have those things in place, then your proportion to cryptocurrency really depends on those pieces. And so it's a hard question for me to answer specifically by a percentage. It shouldn't be the highest thing in your portfolio or the second highest thing. And without me knowing anything, it probably shouldn't make up today, maybe 10%, I don't know, depending on the portfolio, but that's a very high risk. So without knowing what planning has already been done and what path we're on for progression, it's a really hard question, but hopefully those tactics to get there is a really great way for you to understand.
Thank you.
Mhm.
Okay, so this is a multi-part question. Okay, it is about bonds though. Okay.
Mhm.
The bonds that our mothers and fathers or grandparents used to purchase, possibly from the bank, what are those bonds called? That's the first part. Are they still available to attain or purchase? Second part. If they are, where am I able to get them and the general amount that they're going for today?
Great question. Most bonds that were purchased previously were EE bonds, could be Series H bonds. So those were typically what was previously purchased. If there's not a registration that's on file or available, if they're not registered and if you don't have a bond certificate, it may be hard to validate that you actually have ownership to this particular bond. If it is registered, you could essentially go to the U.S. Treasury website. There's information that you can enter from a registration standpoint to see. And if you have the bond certificate in hand, you can actually go to the bank. After 30 years of holding a bond, it has fully matured. And so any interest that you would be willing to or have the ability to gain, you can certainly dial that in at that time. All right, Sora Tiffany.
I'm sorry, I was on mute. I apologize.
No
The
worries.
person asking, are those bonds that their parents or grandparents purchased back in the day, those type of bonds, are they able to be purchased today? And if so, where would they go about getting them?
Great question. So those bonds were typically tied to the U.S. Treasury. So you can still invest or purchase those bonds today. They're really primarily, I'm just going to explain two types of bonds, and it was just dropped into the chat. So you have the U.S. Treasury bonds. If you go to U.S. Treasury Direct, those bonds are for you to purchase on an individual basis. And so that's the way to go. They are still available. What happens is that there are various series that becomes available. So some of the series that I mentioned, the H series is no longer being offered. EE may or may not. So there's various series that roll out, but those bonds are still available to be purchased today.
Okay, thank you.
Mhm.
Next question, is Robinhood a good app for investing for beginners?
It is a good app for investing for beginners. I would tell you, anyone who is a beginner, the best thing is just to get started. I've never used Robinhood. I've known quite a few folks who have, and what I've heard is that it just gets them in the habit of getting started. Typically, when you have those apps, whether it's Robinhood, Stash, you name it, there's some level of knowledge out there where you can gain and you can start to understand. But what I understand by some of those apps is that it sets you up to invest, where you may have a portion coming from your bank account automatically. So it creates habits that could be good for me. If you want to get started that way, I think that's a good way to consider. If you're a do-it-yourselfer, that may be a really great way for you to get started. But after you get started and you kind of get an understanding of the market movement and you want to create something that is more systematic, I would certainly recommend you consult with a professional. But getting started, yes, that's a really good way to establish your footing.
Thank you.
Mhm.
Okay, so this question has been asked a couple times. What type of investment would you recommend to someone that is a complete beginner? Are there any blogs, podcasts, books that you would recommend to get more information about investing? And I'm going to kind of tie it into a question that we got, which is, if a person is in their 20s, kind of where should they be trying to start?
Mm-hmm. So give me that first part of the question again.
Okay. Let me go back to it real quick. What type of investment would you recommend to someone that is a complete beginner?
Okay, first, congratulations. You are ready to invest. I think the best way to get started, if you're completely fresh and you don't know, and let's suppose all you have access to are stocks. Let's suppose What I would recommend there is starting with a company that you follow, or starting with a product that you use, but you know is widely used. Because what you want to do as your beginning is have some type of affinity or have some type of diversification. So that's if you only have access to stocks or you think you may only want to do stocks. However, the best way to invest, especially if you're starting with a regular cadence, you're going to be systematically investing, you're truly seeking to grow and build wealth, you want to start with a diversified fund, whether that's a mutual fund, index fund, ETF. It's going to give you the best of all worlds where you can already have some diversification. You're taking on less risk because when you have just one security, or i.e. one stock, you don't have an offset. So I would recommend that as a starting point. There are several resources and books in terms of getting started and knowing the stock market. And while I can certainly make sure that resources are presented and being out there, what I would encourage everyone to consider in terms of the platform is if you're getting started, just start with understanding the basis of the terminology, understanding the market from a terminology standpoint. There's various podcasts, so many that I can't even name, but what I would encourage is whatever platform you're choosing to invest in, make sure you take advantage of the clicks. Make sure you take advantage of reading the articles, right? But more importantly, as I mentioned before, incorporate you into these scenarios. And so that is the best way to start to develop and learn knowledge as it relates to investing.
Thank you.
Mm-hmm.
Next question. What's the best way to create a retirement fund if you're investing, but not yet have the funds to pay yourself or put money towards a retirement fund? So the funds this person makes from investments, she puts them back into investments.
And the question is, what is the best way to create a retirement fund when you don't have additional funds to?
Yeah, if you're investing, but you don't yet have the funds to pay yourself or put money towards a retirement fund. So it looks like I guess maybe the profit that she's making off of her investments, she's putting them back into the investments. So how then could this person start to create a retirement fund if she's using?
So it depends on what you're currently investing in. Number one, you're doing the right thing. You certainly want your money to earn its own wage, and that's either whether you're getting dividends, which is a profit back from the fund or from the company, and reinvest that is the best thing to do. Allow that reinvestment to occur, and then oftentimes it may even save you on a little bit of interest, et cetera. But suppose that you want to do a retirement account in addition to. Here's the best thing I'm always going to recommend. First thing is whatever is offered through your employer, if you are not self-employed or have a small business, don't leave any money on the table. That is the first recommendation. So whatever is offered, in other words, whatever is being matched, that's the first place. If we want to do something in addition to that, the next thing we have to analyze is what makes the most sense. Should I be investing in this one particular vehicle that I'm currently investing in, or should I switch that investment and start to invest into retirement? If I'm just allowing my existing investment to build upon itself and I don't have funds as of yet, we just start to figure out what capacity do we have to start building funds. Most investments now, a lot of the platforms allow you to start with a nominal amount. So that consistency could be the key there. But I would first tell you, make sure if you're putting money anywhere, and retirement is definitely top on the radar, let's divert those funds perhaps back to a retirement vehicle. But don't leave any money on the table through your employer, and then look at what's most important from a priority standpoint.
Okay, thank you.
Mm-hmm.
So this is probably, it may be similar, but I'm going to ask, how often should you take I'm going to say earned revenue, but how often should you take the revenue from the stock or investment?
That is a great question. Typically in your retirement vehicle, you're not doing that. You're allowing the reinvestments to happen because any type of retirement account is qualified. Therefore, there's tax benefits. And if you take money out, we know the returns. So just for everyone in the audience, this is important to know. This is more of a non-qualified account. So i.e. I'm invested in stocks, individual securities, or I may have some funds, mutual funds, index funds, you name it. That involves a strategy. It is critically important to know As we talked about the bull market and understanding the cycle, and if we've been at this period for some time, it's okay to take cream off the top. So what we have to do is pay attention to what's happening here. You know, how long have I held this investment? First and foremost, be mindful of capital gains. Capital gains is the appreciation on our investment. And once we go to sell or redeem this particular security, based on the gain, we have to pay capital gain taxes. Long-term capital gains is only 15% on average based on your income. The short-term capital gains is 25%. And that is when we have deemed shares or securities within less than 12 months. So the first thing I would recommend there is make sure that we are past the short-term capital gain phase so that we don't have a higher capital gain taxes to pay. And if you are, and if you've noticed that there has been constant appreciation, it's probably a great time to take some of that out. You can reinvest those funds elsewhere. You can pull back your principal. You know, we talk about that terminology as well. So that's a really great time to take advantage of that.
Thank you. Okay. If I am, and I'm paraphrasing this just a little bit, but just like we asked about a young investor, if I am an investor who is a little more mature, so let's say I'm in my 50s and 60s, what would you say should be the, maybe not the goal, but the milestone? What should this person be looking to do with their money?
So I'm going to interpret that in one way as how much risk should I be willing to take? Okay. And also in another way, thinking about, am I leaning towards or thinking about my retirement dollars? Am I thinking about doing additional investment? So anytime we have more than 8 years before there's a need for money, we should be positioned for growth. Doesn't mean that we have to be super aggressive, but we shouldn't be all in cash, even if we're in our 50s and or 60s, because a lot of my retirees, they're not planning to touch this money anytime soon, but we still have a little bit of exposure to the market, or this is more of a legacy component. So we want to be thinking more around that. But if we are getting close, or within a couple of years, or 3 years, or 5, first thing to consider from a risk standpoint is we got to start to rebalance according to risk and scale back for sure, right? That's one of the components that we definitely want to do. If it's not associated with risk, and we're thinking about what else could we be considering as it relates to investing, it goes back to what's important. Am I thinking about creating additional wealth and still accumulating wealth for me to have access to 10, 15 years from now as a supplement to my retirement? Or am I thinking about leaving a legacy of wealth for children and grandchildren? Because those two goals, or even if they were the two goals, they're completely different in the type of investment. That would be the question that I would gauge there. Okay. But if it's surrounding risk, it's a matter of time frame, and we definitely want to make sure that our portfolio is appropriate for that. Another thing that's critically important as we're getting to that phase is cash. The reason why I say cash is because we just saw how the market has, over the time period of the inception since the stock market, has been down. And if you take a look at the market, on average, well, the extent of the market being down has been more than 18 months over a period of time. So we need to consider having anywhere from 9 to about 18 months of cash accessible to some degree. Doesn't have to all be in our bank account. We talked about it could be a permanent insurance solution. You can have other cash alternatives. You want to ensure that you have access to cash. Now, if you have pensions, if you have a system that's going to replenish on a monthly basis, and that's not as much of a concern, you don't need to have the 9 to 18 months, but you may still want to maintain 6 to 12 just for that offset. So those are the considerations as we're more mature and we're thinking about how we're going to grow and build wealth. And if we're more sophisticated, we have to start thinking about proper placement and protection of our assets. So have we done some really great estate planning? Have we done some really great succession planning? Have we protected our assets for whatever may come our way, right? The long-term care I mentioned as well. That is a protector of wealth and your net worth more than anything else. While we certainly want quality care, we don't want to exhaust all our funds. So those are some of the considerations to think through. And if we haven't already done so, longevity is the biggest risk that we have in retirement. Oftentimes we think it's the stock market. It is not. It is longevity first, and then it's a healthcare event. So we want to ensure that we've established ourselves to not outlive our money.
Yeah.
And that's a consideration to certainly be thinking about in our 50s and 60s.
Yeah, those are really good points. Okay, we have two remaining questions. Okay, this question, you did answer it for the person in their 20s. However, I do want to ask this question. If a person is either a recent graduate or a young graduate student, pretty much they don't have the, what we would call the additional monies to invest, but they want to. Where do they start?
Mm-hmm. Thank you for bringing that question back up. First of all, if you have the wherewithal to want to invest, just know that you certainly can invest. What you have to master in your 20s as a recent grad or entry-level employee is your household. And so what I mean by that is start to really take ownership of your budget. Budgets are simply a spending plan. It's essentially knowing I am Deidre Willis, CEO of Deidre Willis Household Incorporated. So I know what's coming in and I know what's going out. So when we're in our 20s, or we're just getting started, we're trying to figure out rent or mortgage, we're trying to figure out student loans, we're trying to figure out how much should I be saving, may have some debt to pay off. The first thing you want to do is incorporate paying yourself. So before we pay anyone else, if you can develop this skill as a new and a recent grad, you would never compromise on it. Because if you think about it, if you don't pay yourself, you will never get paid. You won't have the money set aside. Everyone else will always be paid. So never sacrifice you. Put that as you should be your number one creditor. Put you at the top of the list. Once you do that, and let's say you have a capacity, let's say your capacity is not super great. Maybe it's $200 a month. You can do $100 every 2 weeks that you get paid. Once you start to build that and this becomes more of a habit and you get to maybe 1 month of where you have savings set aside for what it takes to live, then you start to bifurcate your savings. And we're going to do a significant amount, or perhaps you take a small piece. If I can do $100 every 2 weeks that I'm saving, then I'll take $20. And I'm just going to start to build this fund where I'm ready to invest. And when you get to a level of about $500 as a recent grad, you're probably ready to start investing. At that point, you've had more money that you've built up in your savings. You had more money that you probably can now incorporate on a consistent basis. And so the consistency is what's going to win, but that starts with knowing what I have coming in and what I'm going out. Now, if we don't have that capacity, one thing you want to think about is what gives me an opportunity to invest when I do. That could be a tax refund. That could be a bonus. That could be someone giving me a gift. So don't think that everything has to come from you. OPM, other people's money. We want to leverage that as well. Anytime you have surplus, give yourself that opportunity to grow with a course investment.
Okay. And Ms. Willis, this is the last question.
Okay.
Would you recommend taking classes on platforms such as, I'm going to call it Udemy, or it's Udemy, to learn more about investing?
I think there is great knowledge out there. Anytime, well, let me just first say this. If you can vet the source, absolutely take the class. Knowledge is only going to take you to a far extent. Continue to make sure you take that knowledge and you apply it. However, I'm going to share a story with you that all of you probably will be like, are you kidding me? The reason why I want to share this story is because it's not just getting the knowledge, it's moving on that knowledge. So yes, first and foremost, I would recommend that you would, but ensure that it's coming from a reliable source. I know there's a lot of competing platforms, social media that's vying for your attention and for you to take their advantage from a knowledge base, but ensure it is sound and it is expert advice that's governed by a regulation authority, okay? But here's what I want to share with you. There was a young lady who out the gate was really interested in her finances, and she had a really great perspective on investing and saving. and formed this investment club. Started to invest in terms of pooling together with other resources, great minds, had companies that they had identified, started pulling their money together, and as much knowledge as they had, they never did it. I was one of those individuals at the age of 23 years old. So what I'm sharing with you is that it's far beyond our minds to see how we were thinking at the age of 23. And what I've learned is that while we had as much knowledge as we possibly can, if you have 80% of the information, you have more than enough information to make a decision. The next thing you must do is make that decision. So I would certainly encourage you to get as much knowledge as possible, but don't take the knowledge and allow it to store up and become a warehouse. Move on that knowledge, because if you have those other parameters in place that we talked about, emergency fund, proper protection, you're planning for the expected, you can take that risk of what you don't know on that other 20%. So that is my encouragement for everyone here tonight. Thank you again, everyone who has decided to join us. You can see my information on the screen. I would love to connect with everyone in some facet. If financial planning is a goal of yours, if you have learned something that resonated with you, and don't forget your equation. Walk away knowing what is your investment equation. How are you now going to impact your future by taking advantage of the knowledge that has been shared? So looking forward to connecting with all of you.
Ms. Willis, we can't thank you enough. Thank you for giving us concrete steps. We thank you for reminding us that there are things that we need to make sure we have in order before we just jump in there and start investing. But there are so many different ways to invest. And I think what resonated with me is it's personal to you. So I would encourage our participants to please reach out to you if they have additional questions or they want to work with you. Ms. Willis's information is on the screen at this time. And we just want to thank you for taking your time to share this valuable information with our audience. Audience, we are excited that you joined us tonight. We want to let you know that we value your feedback, and therefore we ask that you please take a few minutes to complete the evaluation. It may take 1 to 2 minutes. In addition, we want to make sure that you sign the petition. We have put the QR code up. We have put the link in the chat, but we want you to help us petition to get an extension from the October 31st waiver deadline to the later deadline. So please sign the petition. And lastly, we want to invite you. We have another series on next Thursday, and it will be Cryptocurrency 101. So many of us have literally no idea what cryptocurrency is besides a digital form of currency. And we hear the term Bitcoin, but there's so much more to it. So if that is something that interests you, we do ask that you please join us. We will make sure that we put that slide up as the final slide, but we want to give you an opportunity to make sure that you look at the link in the chat for the survey tonight and the petition. We want to continue to bring you great programming, so please complete the survey. And again, if you want to connect with Ms. Willis, by all means, please do. In fact, I think in the survey, there's some open-ended question. So please share your feedback, and we truly appreciate you. We will go ahead and leave this information up for Ms. Willis, as well as the evaluation and the petition. And I believe we can leave it up for just a few minutes. So we will go on mute. And as our participants are able, please scan the QR or complete the link. And of course, take a picture of this so that you can contact Ms. Willis.